So in this video, we will look at how we can make adjustments for depreciation. Those adjustments would relate to, for example, the useful life assumption as well as the residual value assumption. So once a company acquires an asset, they would need to decide over how many years are we going to depreciate this asset. Is this going to be over 10 years, 12 years, 15 years, but also then after this period is over, how much money do we still get from this machine? Is this 2% of the acquisition cost? Is this 5% of the acquisition cost? And so on. And these assumptions can have major financial impacts. So if we look at the average balance sheet of non-financial companies, we see that these depreciable assets constitute a significant portion of all of the assets. So if we look at net property, plant and equipment of all non-financial US firms, we see that this is equal to roughly 27% of all of their assets. So roughly 27% of the assets are these depreciable fixed assets, which means that changing the assumptions that underlie those assets will have a big impact on the balance sheets of these companies. Now, given that they constitute such a significant portion of the assets, not surprisingly then, there is also a major impact on the income statement. So if we look at the costs that come with using those assets, depreciation, we see that the depreciation expense is a major expense component on the income statement. So again, if we look at the average firm, we see that the depreciation expense is equal to roughly 9% of sales. So for a company that has 100 euros or $100 in sales, on average, they would have a depreciation expense of $9 or 9 euros. So also here we can see that if we start to change the assumptions that underlie depreciation, depreciation expense is going to be different. And given that it's such an important component on the income statements will look different as well. Which is of course important because as an analyst or as an investor, we want to evaluate the performance of a company. And efficient PPE management is one of these components that we want to evaluate, because it's one of these components that it's very important to the success of many companies. We don't want to overinvest and invest too much in fixed assets, but we also don't want to underinvest. So evaluating their PPE management is very important in order to be able to evaluate the performance of a company. And as said, if we start changing the depreciation assumptions, this will have a major impact on the income statements. So if we say that a company has been depreciating too little and we think that they should depreciate more, we want to see what is the income statement of this company and what is the profit of this company after we incorporate these higher depreciation expenses. So having appropriate depreciation expenses has an important impact on the earnings, which then, of course, has an impact on how we evaluate the performance of this company. But as we've seen in the beginning, there is also a major impact on the balance sheet. Net PPE is equal to 27% of all of the assets. So if we start to change the assumptions that underlie PPE, it does not only affect the income statement, but it also affects the value of the assets that we report in our balance sheet, which also has important implications for how we evaluate the financial position of a company. If we start changing the values of the assets, this also has an impact on how we would evaluate a company's solvency ratios and a company's leverage. If we can increase the value of the assets, they will have better solvency and a lower use of leverage. So having these appropriate depreciation assumptions is important for evaluating the performance of a company. And if we disagree with the chosen depreciation assumptions, we can adjust the financial statements and bring them in line with what we would view as a better reflection of economic reality. But also if we sort of agree with the depreciation policies, we can change them and, for example, bring them in line with those of another company, if we want to compare the relative performance of two companies. So for example, if KLM uses a 25-year useful life assumption and Lufthansa uses a 30-year useful life assumption, we could adjust the financial statements of Lufthansa, look at their performance under a 25-year useful life assumption so that we can better compare the performance of KLM and Lufthansa. So let's look at an example where in its 2016 annual report, ABMF states that it depreciates its buildings over 20 years, and let's say they use a 2% residual value. The question would be, what are the adjustments that you want to make or have to make if you believe that a 30-year useful life and 10% residual value assumption is more reflective of the true underlying economic reality? And let's assume a 25% tax rate. So the first thing that we need to do is compare the old, or in this case, actual depreciation rate with the depreciation rate that we want to use, and the depreciation rate that we think is more reflective of economic reality. So if we look at what ABMF has been doing, they had a 2% residual value assumption, which means that over the useful life, they want to recognize as depreciation 98% of the acquisition cost. They want to do so over 20 years, which means that every year the depreciation rate is going to be 4.9%. Now, if we look at what we want to do, we think that a 10% residual value is more realistic. So we want to recognize only 90% as depreciation expense over the useful life. And we don't want to do so over 20 years, but we want to do so over 30 years, which means that our depreciation rate on an annual basis should be only 3%. So once we've determined those new depreciation rates, the next step would be to adjust the accumulated depreciation that has been recorded up until today. And in order to do so, we would need to know the age of the buildings, because that would tell us how many years of accumulated depreciation we have. And to do so, to determine the age of the buildings, we can use the following table. So if we look at the financial statements, we see that the building had an acquisition cost of 24.157 billion. That's how much we paid to acquire all of the buildings. Given the 2% residual value assumption, that would imply that over the useful life of 20 years, we should depreciate 23.674 billion. And it's this amount that we can compare to the depreciation that has been recorded to date. So if we look at the balance sheet, we see that the accumulated depreciation was 13.632 billion. And so we can compare this to the depreciable cost to determine the age of the buildings. Over the 20-year useful life, we want to record 23.674 billion in depreciation. To date, we have recorded 13.632 billion, which is 57.5%. So that means we've used up the buildings for 57.5% of their life, which is 20 years in total, which would indicate that the average age of the buildings is 11.5 years. And it's this that what we can use to determine the new accumulated depreciation. And we can do so using this formula, where we look at the age of the assets, that's 11.5 years. We multiply that with our determined depreciation rate, which was 3%, and we apply that to the original cost of the buildings, which was 24.157 billion. And that will tell us the accumulated depreciation that we should have under our chosen depreciation policy. So the 8.346 billion, that will be the accumulated depreciation that we should have given our 3% yearly depreciation rate. So you will see that I've used the original cost and not the depreciable cost, because keep in mind that this depreciation rate already incorporates any residual values. So if you use the depreciable cost, you're sort of double counting the residual value because it has been deducted when calculating the depreciation rate, so you shouldn't deduct it anymore when calculating the accumulated depreciation. So take the age of the assets, apply the chosen depreciation rate, and use the original cost. And in this case, we would see then that the accumulated depreciation should not be 13.632 billion, the amount that has been recorded in the balance sheet now, but under our assumption should have been 8.346 billion. And that's also the first adjustment that we're going to make when we are going to adjust, in this case, the beginning balance sheet. Because accumulated depreciation should go down by 5.286 billion. So that InBev records 13.632 billion. Under our assumptions, that should have been 8.346 billion. So we want to lower accumulated depreciation by 5.286 billion, which means that tangible assets are going up by 5.286 billion. Now, this also has some other implications, because what we've done now is we've lowered the accumulated depreciation by 5.286 billion, which also means that over all of those prior years, over those previous 11.5 years, pre-tax earnings would have been higher by this amount. Because if we have lower depreciation expenses and lower accumulated depreciation, expenses in those years would have been lower and our pre-tax earnings would have been higher by this amount. And this will lead to two adjustments on the balance sheet. The first one being the recognition of a deferred tax liability that is equal to 25%, the tax rate of this difference. So what we want to do is we recognize a deferred tax liability of 1.321 billion. Now, why would this be? If you think of what this means, over those past years, we would have earnings that are higher by 5.286 billion. And that should also mean that the tax expenses over those years should have been higher as well, by 25%, the tax rate times this difference. So those higher pre-tax earnings would have resulted in a 1.312 billion higher tax expense over those years. And that is what this DTL also reflects. If we lower the accumulated depreciation in prior years, our pre-tax earnings would have been higher, but that would also have translated into higher tax expenses of the tax rate times this difference. So that's one way in which we can see this DTL. The other way in which we can see it is by seeing that we don't make any adjustments to our tax statements, but we increase the book value of these buildings in our IFRS statements. So the temporary difference, the difference between the book value of these buildings under IFRS and the book values of the buildings under tax, has increased. And the extent to which tax depreciation has outpaced IFRS depreciation has increased as well. And that would be another way in which you can see why we have this DTL. Now, the second adjustment relates to equity and particularly retained earnings. Because as I said, if we lower the accumulated depreciation, pre-tax earnings would have been higher by this amount. This has led to this 1.321 billion higher tax expense, but it would also have led to 3.964 billion higher net incomes. We lower the depreciation by 5.286 billion. We increase because of that the tax expense by 1.321 billion. But then the after-tax effect on our profits would have been 3.964 billion. So by lowering the accumulated depreciation, we say that over those past 11.5 years, net income would have been higher by 3.964 billion. Which, if it's not paid out as a dividend, which it's not because we're not changing the amounts of dividends that have been paid out, this should go to our retained earnings, because this is the account in which we can see the cumulative effects on prior year's profits. So all in all, combined, these are the adjustments that we make to the beginning balance sheet. On the asset side, we recognize the lower accumulated depreciation, which increases the net value of our assets. On the liability side, we recognize the tax effects of that in the form of a higher deferred tax liability. And in the equity side, we reflect or recognize the higher prior year's profits in our retained earnings. And then there is one more thing that we need to adjust. So in step 3, we've looked at the adjustments that we need to make to the beginning balance sheet. Then what's left to do is to take into account the effects that we now have during the year and to go from the beginning balance sheet adjustment to the ending balance sheet adjustment. And one thing that we would need to know for this is the amount of buildings that was acquired during the year. Because also on everything that was acquired during the year, we want to incorporate this new assumption. And in their annual report, InBev states that they acquired 69 in buildings. And if we know this, we have sufficient information to adjust the depreciation expense. Where we look at the old actual depreciation rate, so the 0.98 over 20, and we multiply that with the original cost of the assets, 24.157 billion, and half of the buildings that were acquired during the year. Why half? If it's acquired during the year or evenly during the year, on average, we would have had these buildings for half a year. If you buy some buildings at the beginning of the year and some buildings at the end of the year, on average, you would own these buildings for half a year. So take the original cost plus half of the newly acquired buildings and apply the old and new depreciation rate to this. And you would see the adjustment that you need to make, which in this case means that we can lower the depreciation expense that we will see during the year. Under the old depreciation method, 4.9% depreciation rate, depreciation should be 1185. Under our new 3% depreciation rate, depreciation should be 726. Which means that we can lower the depreciation expense by 459, in this case, million. Which will increase our pre-tax income by 459. We lower the depreciation expense by 459, but this will increase our pre-tax income by 459. Which will lead to the following adjustments. One being an increase in our income tax expense and by extension a DTL on the balance sheet by 25% of this. So we have 459 higher pre-tax income. This will increase our tax expense by 25% of this. And this will by extension then increase the DTL on our balance sheet by the same amount, namely 115. And then the remainder will go to net profit and retained earnings. So pre-tax income is higher by 459. We have a 115 higher tax expense and DTL, and the remainder will go to net profit on our income statement and retained earnings on our balance sheet. So we will increase our net profit and retained earnings on our balance sheet by 344.